Hi everyone, welcome to week 2 of MAPC, Management Accounting for Planning and Control, obviously. We're going to continue on with our budgetary control analysis. So just a reminder that the homework that was set last week was exercise 3. That's what we're going to be working through first thing in the class on Tuesday at the start of week 2. So, just a reminder of what we've covered so far then. So remember, we've looked at all of these different variances. So when you actually look at it like this, as I said last week, it's actually quite a lot of variances that you've covered so far. So, you know, it's a lot of information that you've taken in, and it will take time. Just remember to just work through the exercises slowly and make sure that you're okay and that you're happy with what you're doing with your calculations. So we've looked at materials and we broke them down into price and usage, and then usage was further broken down into the mix and the yield. That was the new one for this year. So remember, your mix was all of the input and the yield was the output. What are we getting out from it? We had labour, which was your rate, efficiency and idles, and then our overheads were split into variable and fixed, and they were obviously then broken down further as well. Okay, so that's everything that we've covered up until this point. All of the stuff from last year, plus a couple of new bits that we looked at in week 1. So this week, sorry, not this year, I'm getting ahead of myself. This week we are going to be looking at a couple of new variances. So these are again ones that you haven't dealt with before. These are the sales variances. Okay, so you can see from our wee diagram there, the nice purple ones. We're going to look at a sales variance, and again we're going to break that down into the sales price or the sales quantity. Okay, so what was it that caused the variance in sales? So, as you know, it's entirely possible that businesses will not sell what they think they're going to. Okay, so it's just as possible with the differences that we've seen in the costs. It's just as the same when it comes to the sales. We might see a complete difference in the sales figures that we're expecting. And we have to be able to break that down to figure out, okay, what was it that caused that change in the money coming in? Okay, we might have thought we were going to make sales of £1,000, but maybe we only took £500. So was that because we were charging less for the product? Or was it because we didn't sell as many units? So we need to look into that further and break it down and find out exactly what's going on. So just to give you an example, this was just a budgeted amount of sales. So you can see we've got our sales volume of £7,000, and that came from us expecting to sell 350 units, £20 a unit at £2 profit, which gives us our £700 profit. But what actually happened was we sold £6,000 worth of sales, but we only had to sell 240 units to get that. And the price was a lot more than we thought we were going to, which meant the margin, the profit per unit, was going to be more than we thought it was going to as well. So we actually, although the sales figure, when you first look at it, you maybe think, it's not as good as what we thought it was going to be. Because we've increased the price, we've actually ended up taking in more profit. So, you know, initially it looks like a bad thing, but then when you start delving into it, maybe it wasn't actually as bad as we thought it was going to be. Okay, so the formula then that you're going to need in order to calculate the sales variances depends on the costing technique that the company is looking at. So remember last year in management accounting using IT, learning outcome 4, we looked at absorption and marginal costing. So depending on which technique the company is using will determine which set of formulas they would use for their sales variances. So if they're using absorption costing, then they're going to look at the sales margin variances, okay, and this is the figures that they would be using. If the company is using marginal costing, okay, then we can see that they would actually be using the contribution variances rather than the profit variances. Okay, so we can see all that actually changes there is in that final column we're using our standard contribution, whereas in the previous one we were looking at the standard profit. Okay, so absorption costing, we use the margin variances. If they're using marginal costing, we use the contribution variances. And you'll be pleased to know that's in your formula sheet as well. I've just shoved all of the formulae together, so it's all in one place. And then when you're doing an exercise, at least you don't have to keep flicking through different slides to try to find it. Okay, so our total sales variance then is obviously going to be looking at the price variance and adding that together to the quantity variance, and that gives the overall sales volume, the sales variance, sorry, okay? So the total sales variance is equal to the price variance plus the quantity, exactly the same as all the others. You think of the total materials variance, that was the price plus the usage. So it's the same idea with the sales here. So why might there be differences in the sales variances? Okay, so when it comes to the price, again, it's exactly the same kind of idea as the price when it came to the materials. Why might we have charged less for our goods than we thought we were going to? So you've all done economics now, okay? You all know that if the price goes down, we tend to see demand goes up, okay? So maybe we've reduced the price of the good to try and increase demand and get more people to buy it. Maybe we've got new competition in the market, okay? So if a new business opens up, then we might lower our prices to try and entice them back to us rather than going to this new competitor. We might put prices up to take advantage of the loss of a competitor, okay? So again, this kind of falls back to your economics again. So if there's not as much competition around, we can get away with charging higher prices because people have got nowhere else to go to get them. Okay, so it might be that that's what's happened, that's why we have a variance with our price, is that one of our local competitors has gone out of business, so let's put the price up. Okay, the last one I've got there is fashion trends. So again, we all know that depending on what is in the fashion will have an impact on the price. If something is in fashion, lots of people want it, the demand goes up, therefore the price goes up. So if we notice that one of our products is in fashion, then we might be putting the price up to accommodate for that extra demand. Or maybe we've fallen out of fashion and we have to reduce the price to try and encourage people to buy our product. So that's just some of the reasons why we might have a price variance. When it comes to quantity, okay, sometimes you'll see this referred to as a volume. Okay, it's the same thing, the number of units that we're selling. Okay, so it could be that we have a change in the number of units that we're selling because there's a new competitor come into the market. Okay, so again, it kind of goes hand in hand with what we're talking about with the price. Is that if we have a new competitor coming into the market, then maybe we're selling less because of that. Okay, maybe they're stealing some of our business. Another point, what I've got there is loss of sales staff, morale, motivation through poor management. So if you think about it, your sales staff, you're relying on them to sell your product for you. So maybe we've lost our top salesman, maybe morale is really low, maybe the staff are struggling to sell the product, maybe they feel undervalued at work, so they're like, well, why am I bothering trying to sell stuff for you? So, that could have an impact on the number of units that we sell. So the next point I've got on my list is greater than expected success of an advertising campaign. And that does happen sometimes. People will be thinking, oh, well, we'll maybe sell 1,000 units, but maybe you just get the right advertising campaign and it reaches loads of people, everybody gets excited about it and they go out and they buy your product. Okay, so we see an increase in the demand for our product. The opposite could also happen with your sales staff. Okay, you might actually find that if you've got a great team and they're working really well, motivation is really high, morale is really high, they might actually increase the number of units that we're selling. So we would see a positive variance happening there. And the last one, again, is kind of the opposite to number one. If we have the failure of a competitor, so if a business goes under, then we would maybe pick up on the excess demand. We see it happening all the time. If one shop closes down, people still need to buy certain goods and services. So maybe they will, instead of going there, they come to us instead. So we see an increase in the amount of our products that are being bought. So what we are looking at when we're looking at our variances, okay, is that sometimes we can break that quantity variance down even further into what we call mix and volume variances. So I'll have a wee diagram, okay? So that's our little diagram for our sales. These are all of the variances that we're going to be looking at. So you've got the sales price, which is just the difference in what we thought we were going to sell it for versus what we actually sold it for. And then our sales quantity can be broken down further into our mix and volume. So that essentially is where, when we've got a production process in place, we can generate more than one product from that production process. And that's our mix and volume variances, that's where they come in. So let's have a look at a wee example. Okay, so we've got a company here, Pet Accessories. What else would they be selling? It's me. 3 types of dog leads. We've got standard and actual information. So what they're selling, like I say, there's different types of dog leads. So you've got a training lead, you've got a shock absorber, they're a lifesaver, and you've got the extendable leads as well. Okay, so all of the standard information, this is what we think is going to happen. And then we've got an actual, which is what obviously actually happened. Okay, so we can see we've got the number of units that we're planning to sell, 3,000 all in, and then 3,300 was what we actually sold. So we've got our prices, we've got our variable costs. So from all of that, we can start to calculate what we need to for our sales variances. So in this one, it's telling you to calculate the contribution, volume, mix, and price. Okay, and that's why we've only got the variable cost here, because remember, your contribution is your sales minus your variable costs. Okay, so that's all the information that we've got to work with. So we're going to start working out, right, what are we doing with our sales variances? So using the exact same layout, okay, hopefully this looks familiar to the variances that we did in class this week. We're using the exact same layout. A is our standard quantity, so the number of leads all in that we think we're going to sell, the standard mix, and then our standard contribution. Okay, so the training lead is our first line. So remember, that's our 1,000 training leads plus the 1,500 shock absorbers plus the 500 extendable leads. So all in, we've got 3,000 leads is our standard quantity. That's what we're expecting to make. The standard mix, remember, it's exactly the same idea as the materials. Okay, what is the mix of leads? What percentage of each lead did we think we were going to sell? So we've got 1,000 training leads divided by the overall number of leads of 1,000. Your absorber was 1,500 divided by the overall, and your extendable was the 500 divided by the overall. Okay, so remember, this column always has to add up to 1. I don't want anything coming to 1.01. I don't want anything coming to 0.999. Okay, it comes to 1. So then we've got our standard contribution. So this figure here, remember, like I said, your contribution is your sales minus your variable costs. Okay, so you've got your sales minus your variable cost. And that gives you your 3 there. And then all we're doing, exactly the same as before, 3,000 multiplied by the 33%, multiplied by 3, and that gives you your 2,997. Okay, do that for each of them, work your way across, and then total them all up, and that gives you your 6,999. Do the same then for B, exactly like what we did with the cost variances. We're going to move from standard quantity to actual quantity. So again, we would just take that information from the question. We've got the actual number of units being sold. So that's our 3,300. We're still working with the standard mix, because remember, you're only changing one of these headings at a time as you work down it, okay? So we can just lift all of the information from the standard mix and pop that in here, all of the information from the standard contribution and pop that in there. Multiply across the way, and there we've got our figure for B. When it comes to C, now that we've already got the actual quantity, you can just bring that down. The actual mix, so now this is where you're having to do that calculation to figure out what was the percentages of each of them that we actually sold. So we've had 800 training leads that were actually sold out of the 3,300, giving us the 24%. We had 1,800 shock absorber leads sold, giving us 54%, and we had the extendable 700, giving us 21%. Standard contribution is the same, so you're just lifting that straight from the B table above, and then you're multiplying across the way and getting your figure for C. With D, we're now on to the actual contribution. Okay, so we pull those figures down, and now we need to know the actual contribution. So if we go back to the question, okay, we can see we've got a price of 16 and a variable cost of 13. So that's given us a contribution there of 3, another one here of 3, and another one of 4. Okay, and that's where those figures have come from here. So again, you're just multiplying across the way, adding up down the way, and there's your figure for D. Exactly the same as your costs. Okay, so hopefully it'll be nice and straightforward for you when it comes to the sales exercises. So what you will notice now is that we're using the same kind of idea, you know, our A minus B, B minus C, okay, but when it comes to these figures, this is why I was saying to you, I don't want you getting hung up on what's a negative number and what's a positive number, okay, because when we're looking at it from the sales point of view, it's all back to front, okay, remember with a cost, the negative number, we were treating that as an adverse, whereas in a sales, that would be favourable, okay? So, because this, remember, it's always, the first number is always what we thought was going to happen, and the second is what actually happened. So we thought, in terms of volume, we thought we were going to sell £6,999 worth of goods, but we actually sold £7,699. So we made £700 more than we thought we were going to. With the mix, we thought that we were going to make 7,699. We actually made 7,399, which is an adverse variance 300. Okay, so we've not used a very efficient mix because it's costing us money. And then overall with our price, we thought we were going to make £7,399 charging the price that we were going to charge, but we actually made £10,599. So we've increased sales by £3,200 by increasing the price of the units that we're selling. So hopefully that makes sense and we're all okay. When it comes to the mixed variances, again, remember you are going to have to do a report in a couple of weeks explaining what these variances mean and giving possible reasons for it. So I've just popped up some potential reasons for you. So when it comes to the mix, okay, so if it's an adverse mix, what we're saying is the mix is varied so that a larger than standard proportion of products with a lower contribution are sold. Okay, so it's the same idea. Remember when we said about the mix with the materials, that if we used more of the more expensive materials, we would end up with an adverse variance. It's the same idea here, okay, is that this time what we've done is we have we've made more products with a lower contribution, okay, and that's what's given us the adverse mix. If we'd made more products with a higher contribution, then we would end up with a favourable variance instead. Okay. So, looking at the contribution volume variances, some of the reasons behind that, okay, so if it's an adverse, less products have been sold. That kind of stands to reason, isn't it? That we're selling, if it's the contribution volume variance, we're looking at the number of units sold. So if it's adverse, then obviously we've sold less products, and that could be because we've got new competition in the market, or we've got that sales staff that are taking a hit with morale or motivation for whatever reason, they're not selling as many products as they should. If it's favourable, then those reasons that we talked about before, pulling in that greater than expected success of an advertising campaign, if that's gone really, really well. It could also be that it's just the right time for an advertising campaign. You know, you think about products for likes of in the summer, if you suddenly start, if we had a heat wave and you suddenly start advertising, I don't know, what do we need in a heat wave? Ice cream and cooling mats and fans and all those kind of things. If you time your advertising campaign at just the right time, people are going to go and buy your product. If the sales staff are really good or a competitor has failed, then we're going to see an increase in the number of units. Okay, so that is everything that you need in order to be able to start calculating the sales variances. So what I'm looking for you to do is essentially just make sure that you have watched this video before class, and then when we come to class we're going to start working through exercises and get you ready for the next part. We're not completely finished yet. We've got to be able to kind of reconcile everything and bring it all back together into a wee statement to show the overall effect of all of these variances together. Okay, so Any questions, drop me an email. If you're not sure about anything or if something doesn't make sense, just let me know, and I will answer all of your emails as quickly as I can. And hopefully once we've gone through a few of the exercises in class, everybody will feel a bit more comfortable with it all. Okay, right. Thank you very much. I'll see you later.